Well, good evening, everybody, and thank you very much indeed for spending the time this evening. My name's James Harries. I'm the manager of the STS Global Income and Growth Trust. I'm going to tell you a little bit about what we do here. I'm at Troy Asset Management. We run a number of investment trusts. They're important to our business, and hopefully I'll give you an idea about what we're trying to achieve in this trust. We have 3 or 4 key things we'd like to get across at the beginning, and then I'll tell you something about how we go about achieving that. The first is that we want to invest in a concentrated portfolio of exceptional resilient businesses. This is an equity portfolio that's trying to produce a balance between income and capital. We at Troy tend to concentrate on businesses we think you can say something sensible about on a 5, 7, 10-year view. Now, markets have been rising very quickly recently, people are making a lot of money, and that resiliency and that predictability is something that perhaps has been overlooked maybe for a while. But if we do move into a more difficult period, in chiming with what Peter was saying, well then I think that Troy's approach, and particularly this trust, could be appropriate. The second is that we want to grow the dividend back by genuine cash flow. So we want businesses that are capital light and low in terms of capital intensity, and therefore we're able to both pay the dividend, but also our companies can invest in their business to entrench their competitive advantages. We want to, generally speaking, what we were trying to produce is above average returns and below average volatility, and we think both of those things matter. The return speaks for itself, but also volatility, and frankly, our core customer base for this trust, and probably for Troy more broadly in our more conservatively managed funds, is for investors with irreplaceable capital, and in this case, in need of income. And we think that that often coincides in retirement. And the reality is, therefore, that having income generated from your portfolio allows you to withstand losses with greater equanimity, because you know that your day-to-day bills can be paid and you don't have to dip into capital at times of trouble. And low volatility implies lower drawdowns, i.e. lower losses. We think that the reality is, when one's younger, volatility is your friend. When you're not so young, then avoiding drawdowns is pretty important, because you're seeking to avoid those occasions whereby you simply don't have time for things to recover. Academics call it sequencing risk. How do we think about investing at Troy? Well, we tend to invest in particular sectors and particular businesses. So we favor branded consumer goods, which we think has a good combination of brands, pricing power, distribution, and so on. Healthcare is an attractive sector in terms of predictability and demographic backdrop to the consumer. And software is an excellent industry, generally speaking. It tends to be highly predictable and has high returns on capital employed. Conversely, we avoid large parts of the market which we think are structurally challenged, are too cyclical and too capital intensive, or have low returns on capital. And we would put areas like autos, energy, miners, retail, telcos, utilities in that camp. We think it's hard to say what the cash flows are likely to be for those sectors on a 5, 7, and 10-year view because of levels of disruption which they are facing. Now, you'll notice a number of those are traditionally income-bearing sectors, but we at Troy try to concentrate on sectors and businesses that we think are getting heavier and better over time. This is a relatively concentrated portfolio. It's a 32 stock portfolio today and yields around 3%. We have low turnover at Troy, so we try to interrupt the compounding effect of our businesses reluctantly, which means that we have less than 10% turnover, generally speaking, which leads to 10+ year holding periods. Over the long term, the performance has been acceptable. As you can see, and we are seeking to manage the portfolio in a relatively conservative way. So drawdown should be reasonably limited. We can't guarantee it relative to the broader sector. Sorry, I skipped over a chart. You'll know that income funds, this is the longer term chart for our open-ended strategy, the Troy Global Income Strategy. You'll know that the broader markets run away from income funds largely because of the influence of the very large technology companies. And we have slightly lagged our peers, but we have produced a reasonable return, we think. And if, as Peter mentioned, if we do see a point whereby leadership in the market changes, then something that is a bit more defensive, something that's a bit more conservative, something that's generating a return balance between income and capital, we think may well be a sensible place to reinvest some of those excellent profits which people have enjoyed from the remarkable returns in technology companies. And indeed, we have seen that. We've seen people or clients who have done terribly well in one particular part of the market over really quite a long period of time, and think that maybe reallocating some money to something that's a bit more conservatively managed and it's balanced between income and capital may not be such a stupid thing to do. Indeed, if you are have irreplaceable capital and are in need of income, taking some of those what could be you might say supernormal or fantastic returns and crystallizing or ensuring or enjoying a reliable and growing income stream, securing a reliable and growing income stream at this point may be a sensible thing to do. We have lagged our peers somewhat, as I said, but we have got some of the lowest volatility in the sector in the open-ended strategy since 2016. So I think you should give you a clear idea of the sort of returns that we are seeking to achieve. And this reminds one that when times are tough, the portfolio does relatively better than the broader market. We also have a discount control mechanism. So many of you will be familiar with this. We buy back stock when we're trading a discount, and we issue stock when we're trading at a premium. This has a number of effects. It means that the liquidity of the trust is higher than would otherwise be the case. It means that the volatility of the return is lower. The share price tends to track the NAV. It means, of course, that you don't benefit from being able to buy at a discount, but it means you don't suffer a discount when you come to sell. So crucially, a discount control mechanism gives you the ability not only to deal, but to deal close to NAV. And we think that's something that should be attractive to shareholders. It also, you can see there, the periods when we've traded at a premium enables the trust to grow. Now, I should have mentioned at the beginning, the STS Global Income and Growth Trust is currently merging with another Troy trust, the Troy Income and Growth Trust, which means that the portfolio or the trust will be substantially bigger, over £300 million, and actually the fees coming down a little bit to be better value. And we're therefore excited to be able to be offering a bigger, better value global income trust at a time when we perceive equity markets to be pretty valued. It may well be that we still have a slowdown in the coming weeks and months as a result of the rise in interest rates, even though it doesn't feel like it at the moment because everything's been going up. But we think that actually it could well be a sensible option for investors, and we're very happy to operate in this trust in greater scale. We've got a consistent dividend track record. When we took the trust on, or we were entrusted with the management of the trust in 2020, our intention was to have a sustainable dividend that we could grow consistently through time. We also sought to rebuild the revenue reserve, and we have done both of those things. And therefore, we can face the future in terms of dividend growth for this trust with a great deal of confidence. And over the longer term, the growth one should expect, or historically has been the case for this strategy, is about 5%. And we think that's a reasonable expectation for the future. What's in the trust? Well, we like to, as I say, invest in resilient, predictable businesses. We have a decent allocation to branded consumer goods on the top left of this chart. You'll see that we also have a position in Reckitt Benckiser that's obviously had a challenging couple of weeks. We continue to have faith in that business. We think, particularly those of you who followed it, an adverse legal ruling in the US last week, we think ultimately in time the liability of the share price has built in will turn out to be less than that. So Reckitt retains its place in the portfolio. But as I mentioned, we think the combination of brands, of distribution, and resiliency of these businesses fits the Troy approach well, and I think probably fits the backdrop reasonably well. Of course, some of these businesses, not just Reckitt's, but others, have come down a fair way, and therefore they're much better value than they've been for some time. And they've demonstrated their pricing power in the last couple of years, post-COVID, where they were able to put up prices to protect themselves against greater inflation. We have a number of platform businesses. Chicago Mercantile Exchange is brilliantly positioned for people who wish to hedge inflation risk, interest rate risk, and so on. Intercontinental Hotel Group is a platform business. Basically, it's brands and doesn't own the underlying hotels, software business. Domino's Pizza we think of really as a platform business because of the extent to which people order that over their mobile phone. And finally, Nintendo we're very keen on, perform well for us. We think when the new Switch Pro or Switch 2 is launched, we don't know exactly when that will be taken very well by the marketplace. We have a number of enterprise digital software businesses, which are beneficiaries of the current excitement, but we think remain relatively predictable and reasonable value businesses, even within the context of some other technology companies rising very quickly. And we have a couple of businesses that have moved into the industrial sector, but we still think of them as technology businesses like Paychex and ADP, which are outsourced HR software businesses, really very predictable businesses that grow as people continue to outsource their HR function. And then we've got a number of businesses that we've grouped together as historically dependable yield, such as McDonald's, such as Canadian National, which are world-class businesses which we think have a high degree of predictability and income growth. What have we done in the portfolio? Well, we've done three things recently. We've added to a position in a company called Kenvue. This won't be familiar to many of you, but it was spun out of Johnson & Johnson. It's actually the biggest consumer health company in the world. It has a number of well-known brands such as Tylenol, for the young parents amongst you, Calpol, Band-Aid, and so on. We think as it's come out from under the yoke of J&J and as it receives greater focus from the management team, combined with these attractive brands, we think that will be an interesting investment. And actually, it came down a lot post-spin as people, we think, had a subscale position and just sold it without regard to the valuation, so we could buy it cheaply. Canadian National is Canadian Railroads. They had a few problems in Canada in terms of wildfires and strikes in the West Coast ports and flooding. This enabled us to buy at a decent valuation at the end of last year. It's done very well. And the most recent purchase in the fund is Pernod Ricard. This very simply is the second largest spirits company in the world after Diageo. And the long-term investment case really revolves around Indian consumers buying whiskey and Chinese consumers buying cognac. We think that there's a very long runway for growth in each. There are three areas we'd like to have greater allocation or greater amount of capital. The first is industrials. We view these as high quality businesses, but they are to a degree quite cyclical, and therefore we would wait for them to be better valued. The second is the consumer. The cost of living crisis is real. We think, again, without sounding heartless, that if we do have a more difficult economic environment, then we will get an opportunity to allocate to some consumer businesses, and we put LVMH as an example of that. And finally, we would like to allocate to non-bank financials, but we view them as geared into both the level of and valuation of capital markets, which, as I've mentioned, we think are pretty fully valued, and therefore we're waiting patiently to allocate to that area. Generally, we're trying to optimize income, quality, and growth. And if we can upgrade the quality or the growth, importantly, without diminishing the income, we will do that. But we're waiting for a more opportune moment to do it. This is the portfolio. You can see, consistent with what I said, we have a decent allocation to consumer staples, industrials, healthcare, and so on. And you can see the holdings on the right-hand side and the sorts of size of holding that we are comfortable with. I often think this is the most interesting or most important chart in the deck. We are producing a 5.2% free cash flow yield. That's free cash flow is the money that's available to the business and to investors after all other essential spending has been met, and is therefore, you might describe it as the free cash, the cash that's generated that is available to be distributed or to be reinvested in the business beyond essential capex. And we're generating, and therefore you could view it as a form of yield. So a 5.2% free cash flow yield, which we think is growing at about 5%, and is supported on the right-hand side by a very high-quality portfolio in terms of operating margin, returns on capital, returns on equity, and so on. Now, I mentioned that dividends have grown consistently at about 5%. If one was to take a 5% free cash flow yield growing at 5%, that leads one to think that a reasonable expectation for a return from this trust, not guaranteed, not every year, not in a straight line, high single digits, low double digits, 3% income, 5 or 6% capital growth. If we can achieve that kind of return in the coming years with a relatively reasonable level of volatility, given what I've said about the outlook and about the valuation of equities, we think that'll be a fine result. So that's all I was going to say. Investors have had many years of really quite remarkable gains, and recent months have been a good example of that. I was looking before I came up here that the S&P is currently rising at an 86% annualized rate. It's unlikely that that will continue to be the case, and therefore rebalancing some money away from pure growth towards income and capital may not be such an unwise thing to do. We have seen that with some of our clients, and we think that that this trust can provide that. We haven't really talked about inflation. I think the inflation outlook is highly uncertain. We think we're okay either way. Either inflation comes back and our companies are well positioned for that, or inflation is more persistent, in which case you need businesses with pricing power. That is another good description of our portfolio. So ultimately, we want to be seen as the high quality, low volatility global income fund in the sector. We hope that investors believe that to be the case. That's certainly what we're seeking to achieve. And I hope that that's given you a clear steer on what the trust is seeking to achieve, how we're going about it, and hopefully what sort of return might be available. So thank you very much indeed for all of your time. And I'll now hand back to AJ Bell.